Traders, how are we? I hope we're doing well. Happy Friday, of course. This is a reminder to keep things simple. I'm going to run you through a trade that I'm currently live in, and this is simply using our core strategy, which is a price action based strategy on a trending market. We teach that at a beginner entry level. Of course, there's many advancements to this strategy, but someone with zero trading experience can pick this up quite quickly. I'll try and give you a bit of a breakdown as to where it initially started. I'm personally not one for holding trades long term. My typical trading day is anywhere between sort of 6:30 to 9:30. I typically pull the trigger around 7 a.m. GMT in the morning, and I'm looking for 20 to 30 pips maximum. Taking in some advanced analysis data tools that we use, we was typically looking for Swiss weakness coming up in the near future, which gave me the heads up or the idea or the plan to start holding some Swiss weakness. And I just wanted to look for the strongest currency to trade against. That strong weak is what we get. It gets us movement in the market, and that's typically where we need to go as momentum day traders. Taking that theory into higher term frame trading will require discipline and patience, something I again put my hands up to not having much of. But this is a brief insight into what's possible and what's available if you start to take this industry seriously, and you commit yourself for a long period of time. You work hard, you're disciplined, decisive, and you get thorough education. So this is pound Swissy. I'll just show you on a daily chart. We can see market has been rising, showing daily direction. I wouldn't typically class this as daily trends, just in terms of the cyclicity we're seeing and the strong sellers in an uptrending market. It's typically a sign of caution. Hold back. Swiss weakness has dominated here. Pound strength, pound Swiss long, and about 117 is where this market can get to before seeing an ideal retracement. Yesterday's daily inside candle is usually a candle for me that I would look to close my position. Remember, we're here to make money. We're not here to talk at dinner parties or become an economist. We're here to make money. So any sign of caution is typically when you should get out the market. And then a red inside bearish engulf, a continuation candle followed by which can be a sign of exhaustion, followed by an inside candle is where I would say stop. But I'll walk you through this market now. So daily uptrend, daily pushing on, we can see markets bullish. I'm more focusing on the recent area here. So I've had 1, 2, 3, let's call it 3 days worth of buying before I took action. 4-hour time frame, you can see higher time frame phase 1, higher time frame phase 2 is broken down by cyclicity on the 4-hour market. Look for a 2050 cross. This is something, again, taught at a very basic beginner level and something that we get you guys doing. It stops you analyzing markets that are messy and gets you trading and analyzing markets when we've had confirm a direction. So a 20 moving average and a 50 moving average give us the average price based over a set period of time. When the 20 crosses above the 50, it indicates the market's heading in this direction. And as we can see, we saw an upwards push. Anything after the cross then becomes tradable on the smaller time frames. We have a strategy we call the MA crossover, which would have got us in a lot earlier. It would have got you in on this candle here. However, I start to personally look for cyclicity to ensure I'm timing my trade correctly. If you are a 4-hour time frame trader, you can see that now's the time to think about scaling in. As we've had a phase 1, phase 2, you can see here highs topped out, pulled back, minimum 3-bar pullback. We've had a deeper retracement, stamping its feet on the 20 moving average. We've also got a horizontal level in at 116, psychological round number, ideal area for looking for a bounce in the market. And you can see the last 4 hours of really, or the 4-hour candle has really cracked on and showed a bit of movement. So if you was a 4-hour time frame trader, again, this trade was only taken last Wednesday. You can see the market's pushed up, retracement, looking to go again. However, I would keep in mind the 117 area for potential take profit resistance. Want to start to look at just bringing your weekly pivots as well there, guys. I think we're close to an obstacle. 1-hour time frames where I typically execute the majority of my trades from. And we can see here we've had some nice cyclicity above the moving averages, confirming on the bullish side of the market, upwards and onwards. 1 cycle, 2 cycle, bounced off the 20 moving average. I actually would have ideally liked to get in here. However, I was late to the party today, or that trade last Wednesday. The high of this bar here with a wick at the top, 2 pips above, would have been the ideal entry point. Buy stop pending order. However, when momentum was following through on the next hour, I took a direct to market trade mid-hour. And I was happy to do this, not something that I usually do. Now, price messed around and then we started to take off the following day. My stop loss on this position was 20 pips below my entry, which was just tucked behind or tucked in front of the 50 moving average, which is the red line here. I always go below the 20 personally. My stop loss now is 100 points in front, so I've locked in about 5 grand's worth of profit here. In terms of scaling and scaling in is using profit on your current trades to re-enter new trades without jeopardizing your risk. As an example, if you took a trade last Wednesday and you got a couple of percent in front, your stop loss should be at break even at a bare minimum. If the market turns aggressively, you're stopped out at 0. Now, when you've got your first trade at 0, as in your stop loss is at break even, the 1% you was originally willing to risk on your first trade needs to be re-risked on a second trade. As both trades, first and second, get in front, when we look for our third, fourth and fifth cycle, we're simply using profit we've already locked in to reallocate onto new trades. In regards to core setups, you can see we've got 1 additional entry, 2, 3, 4. You've got 4 additional entries within that 4-hour and daily phase 1. So you've had 4 opportunities to scale in on top of the first trade that we would have taken. We're in a position now where I think we're going to get that additional bounce. So as you can see, just moving up to the 4-hour, this 4-hour phase 1 that was showing direction but failing to pull back, this area here, that's when we drop down to the smaller time frame. We look for our cyclicity, our cycles. I'm liking price action right now. You can see prices, sellers have run out of steam, buyers are taking price back in. I'm going to look to see whether we close above this high here. And if we close above today and we head in towards 117, I'll probably look to continue trading this. And I'm actually looking at a scaling opportunity. It won't be an ideal call in here. I'll be waiting for price to break above 117. In fact, to be on the additional cautious side, I can bring my stop right up to 116 here. And you can see I've got about a 33 pip buffer, which on a 1-hourly time frame is okay. This is running a couple of percent up, as you can see. So if this does get to 10k profit before the end of the day and 117, we're shy of breaking 117, I'll probably just take profit. I don't typically hold trades, so for me this is a test of patience. It's been years since I've held trades, to be honest. I'm typically quite an aggressive trader. I like to get in and out, and I'm quite strict with my routine. I've got so much to do in the afternoons that mornings work well for me. So just a real basic example, one to show you discipline, patience, and most importantly, keep it simple. Trading with a trend is by far the easiest way to start trading the financial markets. Start to understand cyclicity, how the market bounces. As an example here, you've got higher, high, higher, low, and up we go. When we're in a daily and 4-hour phase 1, so the market's bombing on, failing to pull back, that's when you drop to the 1-hour time frame to look for more frequent cycles. So look, guys, get in touch if you find this useful. Obviously, like and subscribe, but more than happy to run you through this. And there's so many advancements to this. This is just what I want beginners doing to get in safely. Okay, guys, all the best. Take care, and I'll see you soon.